Good morning, and thank you all for coming and attending today. Thank you to the ones who have made it here in person, and then the many more who have requested that this be sent out via, a video. So, going to hit today's topic of new construction home management, but we're just going to start with a couple of things to just kind of start and tell a little bit about myself and about my company. We'll make that very brief. And my name is Ryan Heinemann. I work for American Security Mortgage. I have a team called the Heinemann Team. I am a local from Pawleys Island, South Carolina, born and raised. Been in the business started in October of 2000, so 21 years, and have been specializing in new construction. It's been a large part of my business for the majority of that time. So the reason for today is a lot of, as we all know, our inventory is down as far as resales go. So many folks are finding themselves in looking for properties. They're ending up more are ending up in the new construction, new build arena than previously because of that lack of inventory. So the purpose of this, as I'm getting many phone calls in combination with new construction and combination of rising interest rate environment, how do you manage that? Sometimes folks even going into a contract don't necessarily realize, the difference in what all goes with managing a mortgage during a construction process. And so the purpose of this is to simply help educate people so that they can make good decisions about, mortgage choices and know the options in order to even make these educated decisions. We'll skip through some of the. Our company was started in 1999. We are Charlotte-based, North Carolina. Our primary business is in the Carolinas, with some outlying in Georgia, Virginia, as well as we have some operations in Florida. As I mentioned, I have a team that I've created. There's a lovely picture of us, and a couple of them are in attendance today. I am a family-based team, meaning that I have 1, 2, 3, including there's 4 of us that are actual family, including my mother, my first cousin, 2 first cousins. So not the entirety of the team, but we do kind of give that family feel whenever we're working with our clients and trying to take care of them as if they were family. This is stuff that I kind of already went over, so I'm going to kind of jump right into it. Okay, so in order for us to really understand it, let's just talk about the differences between the two processes, so that and then we'll go into kind of the paths that we need to go in and the different options for the new construction. So an existing purchase. Okay, you generally will have, I'll get a phone call. I will help with a pre-approval. Okay, that pre-approval will be sent to you, the client, combination with the realtor. The realtor will present that offer, and if all goes well, you are under contract. Okay, once you are under contract, and this is key because this is in both scenarios, that is really the piece that allows you to be able to lock in an interest rate, which we're going to be focusing on later. So a lot of people don't realize that, but the interest rate is attached to the property. It is not attached to the client. For instance, if you were to go under contract with a property and for some reason via inspections or something, that property went away, whenever you go to the next property, you're subject to current market rates because the rate is with the property. But at the time of the contract acceptance, that is whenever your loan officer should be contacting you and saying, congratulations. Let's talk about interest rate lock-in. And that interest rate lock-in on an existing home is generally somewhere in 30 days. Is more the norm now because everybody's doing stuff so fast, but 30 to 60 days, okay? And so then you're done with that piece. You have either decided to lock in or decided to wait and watch the market, which you can do, but that piece is something that it's a conversation, it's some options laid out, and something that's generally done within that same day or they're very close to that. And you kind of have moved on from that, and then the other pieces start to come in on an existing where an appraisal is ordered, title is ordered, we're collecting the documents, we're getting the full file to underwriting in order to receive the full approval. The appraisal comes in, maybe there's some conditions we work through, and then if all goes well, we end up with a final approve and clear to close. And then we send everything to the attorney, you sit down at the table or do it via mail or however it works out, and you own a house. Congratulations. Okay. And that process all happens very quickly. And, I like to say sometimes doing stuff in a short period of time very efficiently is sometimes a lot easier than doing things over a long period of time and having to have what happens in between when time is called life, right? And so there can always be changes, and that's something else we'll be talking about. So that's your existing scenario, just so that we can separate the difference. Now, moving into purchasing a new construction, that same process starts in the beginning where you have the pre-approval, and then you go into contract. Okay. Now, once the contract is accepted, you should be receiving the same type of phone call from your loan officer. Okay. You are under contract. That is the trigger point that you can, at that point in time, lock in an interest rate. Now, you can lock in an interest rate for this dependent upon the time frame that you are being given in order for that house to be completed. So there's our imperfect situation right off the bat, right? And so number one, that is going to be something that we're going to drill down on what the actual options are there. But ultimately, locking in an interest rate is not the loan officer's decision, the builder's decision, or your real estate agent, or anyone else involved in that transaction other than you, the client. And once you're under contract, provided that your lender has a product that would allow for you, as we do, to lock in for a long period of time, does it all, you should be aware of that offer. And then you can make the decision along with, of course, some advice from the loan officer generally and the builder and everyone involved as to what's the best decision. Does it make sense to lock in now? And so forth. So that's one of the big things that we're going to be discussing and moving into. But that's kind of the whole piece that that's what keeps you up at night, right? In this new construction process. So you still go through the same stuff of collecting documents up front, because you generally, on new construction, you will have a financing contingency built into that contract, meaning that builder wants to not only have a pre-approval, that builder wants the file to go all the way to underwriting. They want the underwriters to see your documents. And even though it's early in the process and you're not going to be closing on that home until a later date, they still want a commitment on file, and that is part of your contract. And if you do not comply with that, you would be in breach of contract, and your earnest money is then in jeopardy. Okay, so that's an important piece of this. A lot of people will say, why are we doing this now? Whenever I'm not even going to be buying, and my situation may look different later, and so forth. But that is part of your contract. The builder has requested that. That is what you signed on for, and so you have to comply, or else you're in breach of contract, and you don't want that money to ever be in jeopardy that you've given them, because it's usually a significant amount with a new build. So we would then you go through your stuff with the builder, you're getting your pricing, you're doing your options and all of that. And let's say that we get all your documentation in, and we get that commitment letter from underwriting. At that point, you've met all of your contingencies and the contract, you take a breath, and now it's kind of, let's decide what we want to do with the interest rate, but let's wait on them to build the house and see what's going on there. And then the final piece that is different from an existing is you're going to have to revisit all of this generally once you're within 90 days of closing, because documents expire. Fannie Mae, Freddie Mac, and FHA, VA, all the major agencies require for stuff to be up to date in order for those loans to meet their requirements, which that's where all our mortgages are going, because that's where the most favorable terms are. Okay. And they're going to update all that. So you're going to kind of do somewhat this process one more time. Okay. So that can feel labor intensive, but there's no way around that. And that's because the agencies set the rules. It's not American Security Mortgage or Brian Heinemann telling you that we have to do that. The agencies do that if you want to get that loan funded at the end. You, of course, then still have the same types of things, but there's more to it with the builder, walkthroughs, inspections. The appraiser has to come back out there and confirm that all the work was done as well. And then you, of course, if all ends up getting cleared, you're going to closing again. But as you can see, we spent more time on this slide than we did on the first slide, right? There's a lot more to this piece, and that's what we're going to drill down on today as far as it relates to the new construction process as mortgage related. So a couple of things that we'll be going over today after I've kind of outlined that is, basically just what you need to know to make the best decision for your scenario. Can you lock in at time of contract? The answer to that is yes. We've already answered that, but we're going to talk more about, like, does that make sense, and depending upon environment and feedback that you're getting from the builder, so on and so forth. We will go over a cost associated with doing these long-term rate locks, and we'll use an example there. And one of the things that I like to go ahead and get out of the way here is who can predict the market and rate fluctuations. So anybody in here, raise your hand if you can do that. I think God is probably the only one that could do that, and I don't know if he's always even sure. So rates will go up, they'll go down, they'll stay the same. That's the one thing I can guarantee. But at the end of the day, no one can predict that. It's not the job of the lender to predict that, the builder or anyone else. And anybody that really tells you, especially in today's environment, that's just, they cannot be certain of that, okay? So, the next question that I get is people say, okay, well, if I'm going to spend this extra money to do an extended rate lock, what happens if rates go down, okay? Unlikely in our current market condition based upon what the feds have indicated as far as continued rate increases and so forth. But what if that does happen? That would end up being like maybe a major military crisis, which, we've had a little bit of that stuff going on, and that could, be something as a negative it would be for us overall. It could impact the market, and you could see rates drop back down due to something like that. So, that's something that we'll address. And then the other is, can I make changes to it, especially because I've locked into an interest rate? Like, what happens if I make some changes to this? Say I've had, something else, a major event happen, I need to borrow more money, less money, so on and so forth. So we'll hit some of those highlights as well. And the reason that we're, kind of leading into that is, what happens during the construction process, which now is even longer than it normally is. Used to be 3-4 months, 5 months was a long build. Now we're 9 months to a year, okay, on a lot of our new builds. So as I like to say, life happens, jobs changes, retirements, layoffs, better opportunities, houses sell, new purchases are made, emergencies, stock market going up or down, impacting assets. There's a whole number of things that can happen in a 9-month period with, the economy, so on and so forth, personal stuff. And, we have to be prepared that, we can't just say, oh, well, that happened. You always have to keep in mind, I've got a mortgage in process. Is that going to impact, during this? Am I creating mortgage sabotage, as we call it, by purchasing this Maserati? Okay, yes, probably so, because it's a pretty expensive vehicle. But, the main thing that we're going to be talking about there is, you can, and I'll go back to this slide, but you can take new jobs, okay? You can put down less money. All of the answers to all of these, you possibly could purchase that Maserati. We may, may not be the best financial decision, but your debt to income ratio may handle that, okay? So there are yes to all of these, but you just need to make sure that you're not doing any of these without first consulting your loan officer, whomever you're working with, going through and making sure that there are no, adverse impact to your mortgage financing. Even putting down more money can cause you to have a higher interest rate than what maybe you had previously locked in. A lot of people don't realize, but the factors for interest rate, one of them also is loan amount. Okay, a $50,000 loan amount does not bring in nearly as much revenue as a $400,000 loan, right? So from the investors in the secondary market, which all things are based upon, that $400,000 needs a lower interest rate to still meet their thresholds. Okay, 50,000 in order to meet their thresholds, we got to charge them a higher interest rate because there's less interest accrued on that. Okay, so that's one of the factors of things that you have to look at, including, of course, credit score, loan to value, debt to income ratio, and all of those other things can still also have impact on your financing terms. So, we will go through rate locks at this time, because that's kind of where, I've kind of gone over and set the stage, but ultimately this is what people are looking for that are currently in new construction and watching the news, seeing the interest rates rise, or thinking about going down this path. What do I do? What's the best decision for me? So let's talk about the eligible products first and foremost. A lot of people and lenders may have some of these eligible. Others may not allow you to do them for certain products. I have worked with my senior management team at American Security Mortgage to create this program specifically. Okay, I went to them. They were already looking to do something collaboratively. We put together this, and we decided that we would include all types of mortgages in this, which a lot of times you'll see people, it'll say, well, we'll do an extended rate lock for a conventional mortgage, but we won't do them for FHA and VA, so on and so forth. We'd, of course, wanted to open it up to all, and I was grateful that they did that. So we don't really have any other loans except for my one portfolio product that we have that doesn't fall into being eligible for this. Okay, so any type of loan is, and that's something that not all lenders, so you need to, if you were going for a VA loan, you would want to specifically ask your lender, do you do extended rate locks for VA? Because that's one that a lot of people do not. Okay, so before we go into the extended rate locks, we'll just outline what a short-term rate lock is. Okay, so that for us, and I can't speak for other lenders, so we will be kind of going by what our company does for now, but we're generally, other lenders have something similar. Okay, usually some do not, but for the most part, the major lenders do. 30-day to 90-day, that's on the existing homes, or many people would choose to wait until they were within 30 to 90 days to lock in an interest rate. I will tell you that doing a lot of new construction, the majority of my folks lock in at that 90-day mark. Okay, that is starting to shift because of the rising rate environment. Okay, if you think about past couple years, this wasn't on the radar. Everyone was, rates were in the twos, right? So nobody was even overly concerned about this. And so we became a little complacent about interest rates. Another just note is, historically speaking, interest rates, even though we've moved up into, the mid to upper 4% range on a 30-year fixed mortgage right now, interest rates are still historically low. Okay, overall time period. I know that some of you out there have had mortgages before I was even in the business, and you've probably seen some much higher interest rates. So, that perspective is still there, and really a healthy economy is somewhere between 6.5 and 7.5 interest rates. That's whenever we're firing on all cylinders. That means people are making more money. Okay, so if that tells you anything about where we are and where we're going to go, like I said, I don't have a crystal ball, but historically speaking, I remember people who were excited to be in the fours. Okay, so it's not the end of the world from that perspective, but you definitely, every dollar counts, every penny counts, and you want to try to do the best for yourself. So that's what we're going to talk about here. So that short-term rate lock, you may utilize that even in a new construction scenario by just waiting until you're within that timeline. There's no additional fees or costs to do that. There is a difference between a 30, a 45, a 60, a 75, and a 90. All of those could potentially have different interest rates. Sometimes one could be the same. The 30 could be the same as the 60. The 60 could be the same as the 90. But there's no real additional cost to locking into those. Those are considered short-term normal interest rate locks. Okay. Currently, American Security Mortgage is running a special where we will give you a 60-day rate lock just because of the market environment. We'll give you the 60-day rate, but we will give you coverage for the 90 days. Okay. And I'm utilizing that a lot right now for people who have been under construction. Now rates are rising on them, but they're within that window. So that's been working out as well. So make a note of that. So then we're going to break down, what does this cost me, Ryan? You know, so if I am, however far out I am, and I want to lock in today, what does it cost? And there's two parts to this. One is an actual cost, and then one is a deposit. And I would liken this to just like an earnest money deposit that you have given to your to the builder or to the seller if it was another one, where you're going to receive that money back at closing. It's 100% refundable. Okay. So there are, and then there's the actual fee, which we'll go over here. And this starts at 120 days. Okay. Up until the 90 days rate lock, you're still in that normal short term that we just went over. Okay. The 120 days is going to cost you 50 basis points or 0.50% of your loan amount. As you see these continue down, you can see more cost is associated. And this is based on the loan amount, not your purchase price, okay? Because we're not securing the purchase price rate lock, it's only the loan amount, okay? So you could be buying $1 million house, getting a $100,000 mortgage, and it's only based on the 100,000, okay? In order to continue to extend those. There is a couple of different ways that this can be paid, okay? Most people will pay it just as an additional fee at closing, okay? It's just like any other closing cost. Some people will say to me, and we don't have many of those in today's environment, but some people will say, can I include it in my interest rate? Meaning we're gonna pay for it by charging you more in interest over the 30-year term, okay? And that generally decision will have a lot to do with how long are you going to hold on to this mortgage. If you're only holding on to the mortgage for 2 years, you got another house selling coming down the road, you're going to pay this off in full, throw it into the rate, right? What's that couple bucks a month to you for 24 months as opposed to paying the full fee on the loan amount, okay? So these fees can be paid or you could do a combination. You could pay some of it at closing and build some of it into the rate. A lot of people in new construction, they're getting incentives sometimes also from that builder, or they're getting incentives from that lender, okay, that you have going towards closing costs. A lot of them are utilizing those where they previously had those set to pay normal closing costs. They're saying, you know what? Let's use that money into our equation as well in order to pay for this extended rate lock, okay? So if you think about it from that perspective, you're using that money, but that was money whenever you walked into the door on that transaction you didn't have. You are using up your incentives, but at least it's helping you to secure an interest rate that, you know, you're going to have for the, you know, the next 30 years or however long you end up having that mortgage. So those are all things that you're going to want to be going over with your loan officer and trying to determine what works best for my scenario. And those life things have a lot to do with that. So it's not all about just the dollars. It also has a lot to do with how long am I going to be in this mortgage? That's probably the biggest question that needs to be answered. People tell me this is my forever home. And, you know, then at that point in time, I'm pretty much all day going to say to them, let's get the lowest rate possible for you, because eventually it's going to make sense that you're going to have a monthly savings. You know, your break point is 3.5 years to where you will have recouped that fee. And then moving forward for the remainder 26.5 years, you've got savings. Okay. So those are different things that you're going to want to look into. The one thing I'll point out here is, as you can see, we can lock in an interest rate up to, you know, 360 days, you know, a full year, basically. So that's the piece where whenever I said in the beginning, whenever you go under contract, your loan officer should be still having that conversation with you that says, we have extended rate locks available if you want to talk about them. Most of my people historically have said, no, you know, we're good. We're going to wait. because it is hard to make that decision at that point because you don't have any idea whenever that house is going to be completed. I do advise people to get a little further into the process. Okay, make sure that everything is getting sorted out. Get through your options. Make sure that there's no major bumps before you pull it. Have some input from your builder, at least to try to gain some type of a range. And I know that's very difficult in today's environment, but ultimately you're going to have to make some decisions that work best for you. And should you lock into something like this, okay, and the build goes beyond, you know, there is the availability to extend that interest rate. Okay, now there is cost associated with that. So that's something you also need to have discussed if you're, you know, getting into a situation where you're locking in an interest rate. Because if I were to lock you in today at 4.5, right? You thought that we're going to be done in 90 days, and then interest rates ended up, of course, increasing, you know, beyond that, and you come up and, you know, you need 100 days to get it done, you know, and interest rate now is at 5.5, you're at 4.5. Certainly you're going to want to extend that for, it's generally a pretty minimal cost to get you those additional days to hold that 4.5 rate. Okay, so that is available. So even if you do miss whenever you're executing these, you know, there is a way to extend those, and you can usually do that multiple times actually. I mentioned early on that the other piece was a deposit similar to what you would provide to the builder, and that's where, anytime we're doing an interest rate lock of 120 days or greater, we are going to collect a 1% of the loan amount fee that is 100% refundable at closing. Okay, so this is just your commitment to us and showing that we have that. The only time that fee is not going to be refunded to you is if you just arbitrarily decide to, you know, go with another lender and leave us, you know, having held that rate for you for that duration and not going forward and closing the transaction with us. Even if for some reason we were ending up not able to do your mortgage for you and having to deny the mortgage, we would refund the money. Okay, so really the only situation is just a situation where we would hold on to that money is if you just kind of went in a totally different direction after we had maintained all the commitments that we had put together, you know, whenever we sat down and had this agreement. The other piece of this is of course the, you know, what happens if rates get better during the time that I'm locked into an extended rate lock. And while this is an unlikely scenario in today's environment, it's something that of course we need to discuss. So I kind of outlined an example in here, and we based it upon a $350,000 mortgage and someone who was executing a 6-month rate lock. Okay, so at this point in time, we use the example of the rate lock being at 4%. Okay, that's the 60-day rate lock. That's what we base all of our rate locks on. Obviously, there's a 1% fee. If you go back to the previous slide to get the 180 days or 6 months, that's $3,500. Some simple math there, right? That is an actual fee. In addition to that, they will collect the deposit of $3,500. That fee will be 100% refunded at closing. Okay. In this situation, you've now executed the 4% rate lock of today with coverage for 180 days, right? This is someone who has chosen to enter into an extended rate lock program. Now, the key component here is, and I'm very transparent about this, and I want to make sure that I always highlight this part, is once you make that lock in, you're in that interest rate and will not be able to have any adjustments made to that interest rate until you come within 45 days of closing. Okay? Once you are within 45 days of closing, then at that point in time, if rates have fallen, you can look to utilize your float down option. Okay? And the way that the float down option works is, for instance, if the current market rate that we locked in was at 4%, and the 60-day rate lock, once we're within that 45 days, is now 3.5, it's not going to go all the way to the 3.5. It will go to an eighth higher than that interest rate of the 60-day current market rate, and that's where we come up with the 3.625. Okay, like I said, unlikely scenario that a float down's going to happen in our environment, but no crystal ball here, and so it's a feature of the program. So I wanted to be sure and outline that piece as well. All right. The final piece that I wanted to put in this presentation, which is something that goes alongside with new construction, and it's a question that I get asked on a regular basis. And the question is, okay, I'm securing a higher mortgage today for the purchase of this home, which is going to be my primary residence. And because we didn't want to move twice, we did not choose to sell our current residence until we were able to, the new residence was completed and we were able to relocate on our own time, fix up that house, get it ready for the market, and then put it on the market. But once that sells, I've financed way more than I need now. Okay, I now have $100,000 that I want to put down on the other mortgage. What's my best option to do that? Do I need to come back to you, Ryan, and refinance in order to do that? The answer is no. And most lenders have this feature. I can't speak for all, but we certainly do. And it's something that people that are making these transitions, a lot of people are retiring to this area, or just plain, relocating to the area, and they have this scenario. The recast is the feature that you would utilize in that scenario, because you do not have to go through a refinance process, which can be costly, and it allows you to accomplish the same goal. So you could reduce the balance by $100,000, and the key here is that in a recast process, whenever you reduce it by $100,000, the mortgage payment will adjust accordingly and go down, all without you having to go through any other, formal process of underwriting or go back to an attorney or anything of that nature. Okay, so that's something that I added to this presentation because it's just a question that comes up so commonly underneath these types of scenarios. So I've kind of gotten through and said a lot there as far as the new construction management, the differences. It is a lot of information. Obviously, we will provide this presentation PowerPoint, as I stated, along with the video. And of course, you can always reach out to me directly or any member of our team, and that information is provided as well. And thank you for your time today.